You're listening to the Perth Property Show, Australia's only weekly property podcast by West Australian experts for West Australian listeners. Catch your latest episode every Monday at 7 a.m.
Good morning, everyone. Welcome to the Perth Property Show. My name's Trent, Fleskens, your host as always. Welcome to episode 301. It's the start of September in 2024, and that means it's time for me to jump into the inbox, have a look at all the questions that have been piling up for the Perth Property Show, amalgamate those and look to add as much value as possible. The last time we did a Q&A was at the end of April, so it's been 4 months. Market's moved a little bit, and a few more questions have popped into that inbox. Let me start with question one. Comes from Sarah. The question is, Trent, I've noticed you referencing the REWA property stats a number of times, and I was wondering if you could break down how to analyze these stats and what they mean for the future of the property market. Great question. To be honest, I probably take these stats for granted these days, but it's important to actually explain what they mean, why they're important. I get it. Thank you very much. Let's start with some demand side factors. The first one being days on market. Now, days on market essentially means from the day it was listed on rewa.com.au, how long until the real estate agent changed that listing to being under offer, therefore not on the market anymore. Now, with all statistics, it's important we have context. And the context for this stat is that 5 years ago, the amount of time it took for a property to go under offer, the days on market statistic in Perth, was sitting up over 2 months in Perth, over 60 days, and across the state, over 3 months. Imagine that you put your property on the market 1st of September and you're not expecting to get your property under offer until November on average. Now, I think it's pretty obvious that the speed at which it takes to sell your property represents the amount of demand pressure in the market versus supply. If you've got 10 people for every property on the market, it's most likely that that property is going to sell a lot quicker. If you've got 10 properties for every buyer, it's going to take a lot longer, obviously, for the market to soak up that supply. The interesting point here is that number has gone from a couple of months to 8 days. And you think about that number, practically 8 days, you go, well, yeah, geez, that's quick. But actually, it's a lot quicker than you think, because any agent worth their grain of salt is allowing that property to spend at least 8 days on the market so that the buyer pool, the market, can actually realize it's on the market, can go to a home open. Let's say you're a real estate agent, you put the property on the market on a Monday, you at least want to have a viewing on the weekend coming up, so your Saturday and your Sunday, and maybe one more on the Wednesday just for people to come back and confirm. So you probably want that property on the market for at least 8-9 days. So for the median selling day in Perth to just be 8 days means that a number of properties are selling in 1-2 days, and the other half are selling around 2 weeks. And then you'll have your outliers, obviously. But really, that is phenomenal when you think about just how quickly those properties are selling for. And they're possibly selling a little quicker than they should for the agent to be able to extract the most value, the highest price for that property for their seller. Now, I would suggest that 8 days is, as you can imagine, a natural zero. It really can't get much lower than that. You really practically aren't doing your job if you're spending any less time on average selling your properties in the area. And that speaks to a stat that agents will spruik is, hey, I've got a median selling days of 6 days. Well, mate, it probably means you aren't working hard enough for your clients and that the sale is coming very easy for you. How about you spend a few more days actually getting the best outcome for your seller? However, I'd rather be 6 days than 60 days, put it that way. So I think a good time that your property should be on the market is somewhere between 9 days and 14 days. It's probably where you're going to extract the most value out of the buyer pool. So there's the first statistic. It's days on market. It demonstrates the relationship between demand and supply. It's a really good derivative of demand and supply with a natural zero of about 7-8 days, let's call it. Let's talk to the next stat. That is stock on market. Stock on market is essentially how many properties in total are sitting there on rewa.com.au at any given point in time. The interesting point to note about that is 5 years ago, that number was sitting at around 17,000 properties. And that most professionals in the industry would suggest that the number of properties on the market when the market is fairly balanced is about 13,000 properties. So when the market's balanced, you have about 13,000 properties on the market. We have just over 3,000 at the moment. And that number obviously has been dropping for the last 5 years. 17,000, 15,000, 13,000. We passed that just after COVID hit. and then it dropped to 10,000. We got to 8,000 2 Christmases ago and thought it can't get lower than this. It really never has. And then it got to 5,000 last Christmas, and we thought, well, it can't get lower than this. It's nearly impossible. We're nearly at another natural zero. And now we're in September 2024, where we seem to have hit a bit of a natural zero, sitting at around 3,300 right now. And that obviously is made up of houses, of units, and of land. Now, obviously, you can't move into land. So if you buy land tomorrow, of which is about 600 blocks of land on the market any week right now, it obviously is going to take a couple of years for you to move into that. That doesn't help the dynamic of demand and supply straight away. A really interesting stat that comes out of this one is essentially your stock weeks, let's call it. What does that mean? It means how long will it take if you didn't put any new stock on the market for the weekly transaction numbers to absorb the whole market. And it's a really interesting way to analyze the relationship between demand and supply. So for example, back in 2018-19, when we had about 17,000 properties on the market, we were selling about 550 properties every week. That's what we were transacting on, which means there was about 30 or so weeks of property stock on the market at the time. Fast forward to 2024, we're transacting at about 900 properties a week right now, and there, as we said, 3,300 properties on the market. So what that suggests is that we have under 4 weeks of stock on the market. If no more stock was to come on the market today, from now on, we would only have 4 weeks of properties on the market, of which about a fifth of them is vacant land that we can't live in. That dynamic is phenomenal. To go from about 30 weeks to less than 4 weeks of stock demonstrates the pressure we have in the market and demonstrates why prices are growing so quickly, because there just isn't the amount of choice and properties available for the amount of people demanding property. Now, we've given the next statistic away in transactions every week. Now, obviously, that talks to demand. You don't have a transaction without demand. You've got the supply side sitting there, that's stock on market. We just talked about that. But transactions every week occurs when there is a piece of demand for that supply waiting on the market. Now, as I explained, 5 years ago, we were transacting at about 550 properties every week. That peaked up to an average of about 800 properties in the last mining boom 10 years ago. And that was pretty unfounded at the time to have about 800 properties transacting every week. A lot of work for settlement agents, mortgage brokers, building inspectors, real estate agents as well. Now, the interesting point to note about that is that since 2014, as I said, it dropped down to about 550 just before COVID. And ever since COVID, that number has sustained itself nearly every week above the mining boom, above 800 property transactions a week. In fact, there have been many weeks that have been above 1,000 transactions. So on average, we're at about 900 or so transactions a week throughout the year. And that number has been constant as an average for the last 5 years, which represents the sustained unprecedented buying pressure we've noticed in the industry since COVID. And you only need to look at that mining boom number of about 800 to understand the context of how that felt back then versus how it is right now. So every week, when you think about the amount of property on the market having dropped for the last 5 years, if we've had about 900 properties being bought every week, and we're losing, let's say, 50 or 100 properties in stock on market on a weekly basis, thousands on a yearly basis, until we get to just over 3,000 properties on the market, it means that the amount of properties we're putting on the market is not equal to the amount of properties we're transacting on. So maybe we're buying 900 a week, we're only bringing on 800 a week, and that has been constant for the last 5 years, which is how we've gotten to this position of having the lowest amount of properties on the market in recorded history in Western Australia. So that's the sales side. Generally, we'll look to those statistics: median days on market, stock on market, weekly transactions, and sales weeks. And what they are is very easy to understand indicators of the balance of the market right now. So if anyone right now is suggesting, hey, Perth's had its run, Perth's too expensive, people are leaving Perth, people are selling from Perth, all you have to do is look at those statistics to recognize that, hey, we are at the lowest amount of properties available on the market in recorded history, and we're sustainably still transacting at between 800 and 1,000 properties every week this year and for the last 5 years, and that the amount of time it takes to sell a property is as low as it's ever been. And then we can speak to the substitutable market, being the rental market. Well, the amount of properties on the rental market is about 2,000 properties. In Perth's darkest days, it was about 11,000 properties. And at that point in time, the rental vacancy rate was 7.5%. It took weeks to rent any property, and you were discounting the rent to a price that had our median rent sitting at about $350 a week. It now sits at about $650 a week, which represents an approximately 85% increase in the price of rent in the last 5 years. It's interesting to note that at that same point, we've also dropped stock of about 80% as well. So there's a very tight correlation in the rental market of the relationship between demand and supply, and what that's done to stock on market. It's dropped by about 80%. And what that's done to price, well, it's increased by about 80%. It's pretty basic year 10 economics when you start to look at that. And what that spits out at the end is a rental vacancy rate of point something percent, whether it's 0.3%, 0.5%, 0.6%, it really doesn't matter. It changes every month. The point is it's not 3%, it's not 4%. It's sort of a natural balanced market where rents aren't going mental, where there aren't 20 people at every home open. It is the lowest vacancy rate we've ever had, again, in recorded history. And that's the concerning part for this market, is that whilst it's probably stabilized at both the amount of stock on market and the amount of rental properties on the market, it's stabilized at the lowest number ever. And it's not increasing in a material way. It hasn't bounced back. And that's because this market, whilst it's financially incentivized to, prices have risen, rents have risen, it hasn't got the capacity to provide the increase we need, which is supply. There isn't the capacity to increase materially supply unless you convert owner-occupied properties to rental properties, because there isn't the capacity to build more properties right now. And I'll reference that number now. This is a HIA statistic rather than a REWA statistic. HIA and the federal government have recognised we need to be building about 25,000 homes a year. And unfortunately, the capacity we have in this market right now is about 16,000 homes every year, about 4,000 properties a quarter. We're approving about 4,000 new homes and we're completing about 4,000 new homes every quarter. So as we continue to have this deficit of about 9,000 to 10,000 homes every year, and we have done for 5 years now, we continue to create this deficit in the relationship between demand and supply in our market. And that is exacerbating the problem. What's happening there is, well, we're increasing the amount of people that are living in a household. We're having housemates for the first time in a decade. We're having granny flats become viable options to provide and live in as well. Airbnbs are full, and the pressure on social housing, given there's no space left in the private rental market, is as high as it's ever been. Over 20,000 applicants sitting there waiting for the government to provide a roof over their head for them. So what I'm suggesting is that not only are we still in the tightest market, we are now in the most expensive market we've had, and there is still no light at the end of the tunnel in terms of our ability to fix that problem. What does that mean? Well, it means that to the extent that we can afford to, being the extent that the banks will give us loans to, our prices will continue to rise in Western Australia. And that is the key factor here that a lot of East Coast investors seem to miss, is they act like a swarm of locusts, a herd of wildebeest. They've spent a couple of years here and they automatically think, well, it's been a couple of years, I guess the Perth market's done. Well, it's not done until we can provide the supply we need to meet the demand we have. And the demand we have last year was 98,000 new people who would ordinarily require about 45,000 new homes. Now, we're speaking about 25,000 new homes. Last year, we would have needed 45,000 new homes. Now, that is the highest immigration rates in the country. They won't be abating anytime soon, because what we need are people with trades to fix the problem we've been building up over the years. And that's why the state government through the federal government is now finally seeing trade visas start to get approved in Western Australia. The crackdown on the CFMEU seems to be having an impact, which is fantastic for our market. Quick fact before I move on to the next question, and this has been a long answer. What percentage of our supply do we believe is coming from infill right now? Have a think about it. Do you think it's 70%, 50%, 40%? Well, unfortunately, it's less than 10%. And that is the big reason why we have minimal capacity to meet demand right now, because the land industry is choked, as Cole Dutton said last week, by planning and infrastructure agencies that essentially aren't allowing any more than the 16,000 homes a year that are being built. That's the cap for land. And whilst apartment buildings continue to be uneconomical or unapprovable in Western Australia, we aren't going to be able to meet that 25, even 45,000 house mark we probably do need to be able to balance this market out anytime soon. So in the meantime, there's only one thing that can happen to prices in Perth, up to the cap of affordability. And we know what that cap is because we make the same amount of money as people in Sydney. We pay the same interest rates as people in Sydney. Therefore, the theoretical cap is prices in Sydney. Thanks a lot for that question. I really appreciate it. Big answer, but hopefully it was informative. Next question. Trent, can you please do an episode on the City of Melville's proposed planning updates, which landed in the last couple of weeks? Look, I can't do an episode, Mike, but I can provide you some information. Essentially what's happened is the City of Melville, as every city is supposed to do every 5 years, has provided a draft update to their planning scheme, essentially in the residential space, the zoning, where their zoning, where you can subdivide, where you can't. And a few points of interest. Whilst they are looking to increase the zoning in areas around Booragoon, some in Leeming, some in Applecross, and some in Cardinia, they've actually looked to pull back the zoning around Helm Street and the existing apartment buildings in Mount Pleasant. Now, obviously, that's come off of backlash of people suggesting there's way too many apartments in the Canning Bridge precinct area. They've pulled that back from essentially a 5-story limit to a single house. It's very interesting to see where they look to tweak that. And what that does is signpost that when we have an update to the planning scheme, it doesn't always mean more density everywhere. Sometimes they tweak it and go, well, look, we've pushed a little bit too hard here. What we're going to do is we're going to pull back on the apartments near Cirque, near Sabina in Mount Pleasant, and we're going to have a bit more townhouse opportunity in the suburbs around your Booragoons, your Leemings, Applecrosses, these areas. So that's the update there. What does it mean? What it means is in the micro space, there are a few properties there, Cardinia, as I said before, that will have higher development potential and possibly higher value because of that, because of the profitability of that. The highest and best use has increased. What that also means is probably those properties around Helm Street in Mount Pleasant that have been dezoned probably lost some value in that space too, but it has come on the back of community consultation. That's what the community has asked for. That's what they get. All right, next question. I was thinking perhaps an update on building and construction in terms of tradies, availability, renovations, wait time. This comes from Jace. Jace, what I would suggest you do, have a look at the episode we had a couple of weeks ago from Jay Walter. Hopefully you had a listen to that. And for everyone else listening, if you're looking for an update on the building industry, we interviewed the head of JWH Group, Jay Walter, only a couple of episodes ago. Please have a look back for that information. Great episode. Next question. How is the land development industry going in the regions? I hear some estates are selling out as fast as in Perth. That's true. Great question there, Melinda. Not only are we seeing land estates in Perth's fringes, so up around Alkimos, Ellenbrook, Byford, Baldivis, your Piara Waters areas, Wellard, pretty much selling out within a week or so of titles. Nigel Satterley's announcing new titles every week. I'm not sure why they're coming out 6 titles at a time when they're developing 30 or 40 lots at a time. But anyway, they are selling out like hotcakes, and they're selling out at prices 30 or 40% more expensive than I was witnessing a year ago. So if you were buying a block for 300 grand last year, you're probably paying 400 grand for it now. Same block, same location. A fella last year paid 100 grand less than you are for your land. Bit of a kick in the teeth, but that is demand and supply, and it talks to the massive migration people are pushing towards building again, not only in Perth, but in the regions. So places like Spindrift, places out in Dunsborough Lakes, Bustleton, in Bunbury, Treendale, all these areas are seeing big demand relative to the supply, but also is relative to the towns as well. Again, where prices for land have risen up to about 50% in the space of a couple of years. And the reason for this is because it's a capitalist free market. There is probably 2 or 3 buyers for every piece of land out there, and the land development industry moves much slower and with much more risk and cost than in Perth itself. So what is being developed could be it for years to come. And what that speaks to across the board is a couple of things. One, population growth. People are not only moving to build in Perth, but also the regions where they're hopefully finding great jobs. But 2, they're being sucked back into the house and land space at the expense of and in the absence of the infill space. There just aren't minimal options to move in tomorrow into the apartment space, but also the townhouse and villa space in Perth. With a medium density code coming in at the start of this year, that's not going to make it any easier. There will be far less villas in Western Australia going forward, and those that do come through will be townhouses and will be much more expensive to build regardless of the cost of construction in the industry. So most of that pressure is now going to the land space, and they just, whether they would like to or not, do not have the capacity to provide more land than they already are. So what we'll continue to see, price rises in that space. Next question. This might be a silly question, but what exactly happens from when a seller accepts my offer to when I get the keys? Not a silly question at all. We've all asked that question at some point in our life before we did it for the first time. So let's run through it. Let's assume you've got to that point where you're making an offer on the property. We'll talk quickly to it. The first thing you want to do is obviously think about price. Make sure that the price you're providing right now in this market is the best price you can offer, one that you can afford, that you probably have pre-approval from a bank via a mortgage broker. and one that you're comfortable with if someone ends up paying more than you right now. That essentially has to be the mindset right now in Perth if you're looking to buy a property. You want that deposit around Perth generally be $10,000 unless you're in the western suburbs where they'll want 10% of the value. But normally $10,000 deposit will do it. Paid within 5 days is totally acceptable in this market. That money goes to the seller's settlement agent and sits in a trust account. And if you don't get financed, you get that money back. Now, let's say your offer is accepted. Congratulations. You'll pay that deposit within 5 days. You then probably have a building inspection clause. You want to organize your building inspector straight away to go out there and make sure that they can check the property is structurally sound. Now, what the REWA form will generally say is that if the property is not structurally sound, the seller has the right to fix it, or they have the right to say, nope, I release you from this contract. It doesn't give you the right to walk away, unfortunately. It also doesn't give you the right to walk away for any minor or cosmetic issues that aren't deemed structural under the joint form of general conditions, which is like the rule book that sits with the contract that you have signed. It will be attached to the email you get from the sales agent. So make sure that you're really happy with the property. If you don't like the cosmetic side of things, don't expect them to get fixed. They're probably not going to. You'll also want to get a termite inspection. Generally, that will come up without any issues, but you want to make sure that you do it just to be safe. You've also gone and given your contract to your mortgage broker the day you had it signed, that you had your offer accepted, because your mortgage broker is going to then go and get a valuation done, make sure that the bank can formalize that pre-approval you've gotten over the last couple of weeks so that you can get formal approval, because you probably had a condition on your contract that said that the offer is conditional to finance within 21 or 28 days. That meant that you had that 21 or 28 days to go and get finance. If you couldn't get approval, you would then get a decline letter from your mortgage broker, and then the seller would have to refund your deposit, that $10,000, let's say, that's sitting in their settlement agent's trust account. Let's say you've got finance approval. Congratulations, the contract is unconditional. It means that you are going to get this property as long as you hand over the money via the bank on settlement date. Settlement date is probably 14 to 28 days from the finance approval date as per what you agreed in the contract. At that point in time, you'll then get your furniture removalist ready to go. You'll do a final inspection within a week of settlement date. If everything's good from there, your settlement agent, who you have organised within 3 days of making that offer in the first place, and the seller's settlement agent talk to each other on an online platform called PEXA. They'll talk to your banks. They will get your money for your proceeds for the purchase. They will essentially formalise the transaction with Landgate. At that point in time, your name would now be on the title, you own the property, and you can pick the keys up within about 24 hours. That's how it works. Hopefully that all made sense. Next question. I'm looking to buy my first investment property. Trent, if you can imagine this is for you, can you walk me through your selection process for where and what you would buy? Now, the first thing I'll be doing is picking my asset type. That would always be second-hand house on a subdividable block. That block would be 700 square meters or more. I would try and ensure it is not too sloped, so I wouldn't have future retaining costs in my development or the future buyer's development. That is essentially a negative value to a property having slope on the block. I would want that property to be within 20 to 25 k's of the city, and I would want it to be as close to the water, the city, good schools, and good activity centres as possible. That can be north, south, east, and west. And from there, it just really is based on my budget. That budget is going to determine whether I'm 10 k's out from the city, 5 k's out from the city, or 25 k's out from the city. But regardless, the property I'm looking for meets those qualitative metrics that I've just spoken about. From there, what I'm looking for is a house that is rentable, that's going to service a lot of the loan, maybe not all of it, but a lot of it. And my focus is looking for a property that's going to make me capital gains through eventual subdivision and or development in the future. I may not do it, but someone like a developer may pay me a lot of money for the access to do that in the future. So whilst a lot of people talk to rental yield, to cash flow, that is not my focus. It never has been. I'm not bothered if I lose $10,000 or $15,000 in the year. If I can't afford that, I shouldn't be investing in property. What I'm looking to do is find a property that not only through passive gains, but through manufacturing wealth through subdivision and development, I can make hundreds of thousands of dollars on that property in the future. That is essentially my selection criteria. It doesn't speak to the exact suburbs I'm looking at, which is obviously budget related, but it speaks to how I would go about finding those properties. Next question. I'm hearing a few YouTube investor channels from the East Coast suggesting Perth is done. What are your thoughts? Well, I guess I would refer you back to the first 18 minutes of this Q&A. to be frank, anyone from the East Coast who is a buyer's agent or speaking with a level of authority on the Perth market probably can't name 20 suburbs in Perth. They probably don't understand the zoning framework. They probably couldn't name 10 local councils. What they are talking to is essentially the herd from the East Coast. And if you are an East Coast investor who has minimal understanding of West Australia's marketing, you're just looking for safe, passive growth with minimal need to understand the market, you're just buying a house, doesn't really matter what you buy, and hoping it goes up over the next 2 years, well, yeah, the last 3 or 4 years has been a great time to do that for dummies without any real research. And if you were to continue to do that in Perth, at some point in time, you might overpay. You might overpay in a suburb that has probably capped out in terms of affordability. But if you were to do any research on Perth in terms of the dynamics of demand and supply, in terms of affordability, in terms of demographics, in terms of where infrastructure is going and where people are going, then you would recognize that, as I said in the first 18 minutes of today's podcast, there are still massive upsides in the Perth market that theoretically cap out at Sydney's price point until the dynamics of demand and supply change. Now, what that means is that we can't just blasé be buying into Gosnells, Armidale, Rockingham, Mandurah anymore. We need to be employing strategies for why our properties be worth more in the future. It may be house value. It may be development value. It may be renovation value. It may simply be that, yes, this suburb has been left behind for a while and actually have to do some research. All of those factors are normal market factors that you would take into consideration and prioritize when investing into a market you believed had future upside, and not just migratory, blasé, plague-like national investment strategy. Feel free to keep listening to the East Coast investor channels. They obviously speak to where the East Coast market's going. At some point in time, that market, for the reasons I just spoke to, will probably pull out of Perth. They will start selling down. But that's not to suggest that the dynamics of demand and supply are materially impacted or defined by the percentage of property of buyers that are investors from Melbourne, Sydney, and Brisbane. What we also need to consider is that Perth's West Australian equity space and investors, people who know Perth, are just getting out of second gear, to be frank. These are people who just now finally have a couple $100,000 of equity in their property and are looking to put it somewhere in the market they know. So as you might have some East Coast investors start to cycle out of Perth in the next couple of years, those investors will probably be replaced by West Australian investors with their own equity and their own intent to invest in their own market. The fact of the matter is, until the fundamentals of demand and supply change that we spoke to in the first half of this episode, prices can only continue to rise in Perth. We need to solve the supply problem to stop the price rise problem. Okay, final question for today. And this is, I guess, a holistic question that could pertain to a lot of people in West Australia right now. Trent, I've got a 4x2 in Coolunga, which is essentially East Rockingham for those listening. I've owned it for 20 years. The tenant has just moved out and I have an opportunity to sell it if I wanted to. Should I sell it now or should I release it and keep holding it? Dave, thanks for the question. My answer to you is the same answer I would give anyone, to be frank, is don't sell unless you have to. Property is a long-term asset. It's a nest egg asset. It's not one that you should be investing in, as I said before, for cash flow or for immediate gains. It's one that is essentially going to assist you with your retirement, paying down your mortgage. So unless you have a better strategy for the money you would take out of that sale than the forecasted growth in the Rockingham area over the next couple of years, then don't sell. If, however, you do have a better strategy, it might be paying down your loan and changing your lifestyle. It might be I need the money for my retirement. It might be I've got a better investment opportunity that has higher growth than, let's say, 10% a year. Well, then fair enough. That is a great example of how you've made money through property in your passive investment, and you can now switch that out to another strategy that works for you in your risk profile today. But to talk specifically to the area of Rockingham, it's had a massive gain over the last 5 years. It's gone up the better part of 70, 80%. Some would suggest it's hitting caps. Some would suggest it's probably just balancing out to a price it should have been given its coastal location and its proximity to the Henderson Marine Complex, which has a lot of work coming through with AUKUS over the next couple of decades. I would suggest that wherever you are in Perth, if you've held property over the last 20 years, you've probably seen price growth of at least 70 or 80%, or you should have if you bought well. And it means you have opportunities not only to reinvest the equity you've made into other investments, whether it's property or other yielding assets, and it doesn't specifically mean you need to sell. I hope that answers the question. Again, to summarize, only sell if you have a better thing to do with that money that you are taking from the sale. Otherwise, continue to leave that asset without triggering a tax event in a market that broadly is expected to continue to see growth over and above inflation. Guys, there's 30 or so minutes of Q&A for the third quarter in 2024. I hope you guys got some value from that. We'll be doing a suburb spotlight next week in Queen's Park. Thanks for listening.
Thank you for listening to another episode of the Perth Property Show. If you've only just joined the conversation, you can catch up by heading over to our website, perthpropertyshow.com.au, subscribing to the podcast, or joining our Facebook page. Don't forget to tune in next Monday at 7 a.m. for more expert insights, local analysis, and suburb spotlights. Happy hunting!